Good evening, everyone. Today's date is November 14, 2018. I'm back again with a before and after picture on a chart that I posted. Tonight I'll be covering the S&P 500. I'm using the SPY ETF to track that. I posted this chart on Sunday night. You can see here Sunday at 11:02 p.m. I was looking for a big move to the downside here at about 267 and some change, and this here was a minor double top. A true double top really comes at the top of a chart, so this here is considered a double top. So I really wouldn't call this a double top per se, but this is more of a 61.8 retrace. So I was expecting a move to the downside here. This was my potential downside. And fast forward to today, you could see that I actually missed it by, let's see, a couple of cents here. If you look at a 10-minute time frame, the low today was 268.46, and my line here was drawn at 268.11, 268 maybe 12, but really close. I did hold some puts on this. I closed them out today for a very nice profit. So that was my potential downside. I do expect a minor bounce moving forward, but I would like to go on record tonight and point this out to you guys. I think this is very important. We are starting to see signs of, in my opinion, big institutions unloading. As you guys know, the S&P 500 has had a major move to the upside in 2018. A lot of reasons for that. QE is one of the main ones. Infinity QE printing of money. That right there is not healthy. Just one thing to point out is we are now below the 200-day moving average. It was supported here on February 9th of this year. Once again here in April, here in May. So this was the first sign of this market really starting to turn to the downside. We did make a high of about 293 and some change, but long term, I really do think that we are heading back towards 2015 highs. And you could see here on a weekly time frame and a weekly chart here back in December of 2014 all the way through 2015 to June of 2016. So you could see here this was a major area of resistance here at about 209, maybe 210, before breaking up to the upside in 2016 and reaching all-time highs. Now, looking at the chart here, this is starting to look a little weak. And like I said, it looks like institutions are unloading, in my opinion. Right now, we are closed on a weekly time frame. We are below that 50 MA. The 200 MA I expect to slope up slowly. Right now it sits at about 230, but I do expect long term, in a couple of months, maybe sometime mid next year, I do expect price to eventually head back down to the 212 price. I do think this will be a healthy pullback. By no means am I saying there's a market crash right around the corner, but I do think that it's time to pull back. I do think that the bull market is coming to an end. So take advantage of this opportunity. I know I will be. Once again, 210. If you look left, this was an area of previous resistance, which should now become support. Long term, longer than that, I do think that the market should actually head back even lower. Let's look at a monthly time frame. Very, very straightforward. This was the dot-com bubble, the crash. This was the housing market crash here. So this was in 2000. This was 2007, 2008. And this is my first target. But again, just like mentioned here, previous resistance becomes support. I expect the market to head down here to 212, give us a minor bounce, go sideways, and eventually longer term, I do think that once we head down here at about 150. So that's a big move considering this is at 270. All right, so a move down to 150 would not surprise me. I'm sure the news will be all over this saying, this is a recession, and who knows, we may go back into a recession. I'm not here to give you any investment advice or anything. Excuse me. This is just what I'm seeing. These are my opinions. So that's what I'm seeing here. Very straightforward on the chart. You can see here once again 211 first target, and long term 156, probably maybe 160. And you'll see that 200 MA is sloping right into that level right now. This would be healthy, I think. What goes up, it has to come down eventually, as noted here back in the 2000s here, back here in the 2008 market crash, and here we are. Looking at the monthly here, this is a bearish engulfing candle. We are hanging on to dear life off of that 20 MA. So it closed below the 20 MA, and I think that the market will flush down towards that first target of 210. All right, so that's what I'm seeing on the S&P 500. Just to keep it short, but there will be bounces along the way. I'm not saying, by any means that this thing will just crash to the downside and every day will be a down day. But that will not happen. I guarantee that. Just my opinion. I do think that there will be bounces along the way. But like I said, long term, this should head down to about 213, 212, somewhere around that range. And I'll go ahead and give this to you guys here. If once again you pull your Fibonacci tool from low to high, you can see where these levels line up very, very well. The 38.2 retrace lines up with that level, and the golden ratio 61.8 level ties in exactly with the 2000 highs and the 2007, 2008 highs before making that big pullback. It's very straightforward on that right there. Just thought I'd go ahead and put that out there on record and upload it to YouTube. That's all I had for tonight. I'm going to get some rest here. It's 10:30 where I'm at, and I'll see you guys maybe tomorrow in the next video. Thank you.